welcome to episode 15 of Top of Mind with Consilio Wealth. We are back once again to discuss an update on markets. Markets have actually opened up this year. For context, it's January 31st. So we've got the last day of January. We've got a positive rate of return so far this year. So Hao and I thought we would discuss that, as well as sort of what happened in the back half of last year and some other interesting things. Housing seems to be showing life, signs of life. International is performing pretty well. So we have a range of topics to discuss today. So Hao, let me turn it over to you. How are things? It's great to see you.
Great. Good seeing you. And I think people are listening to us and thought we took a 2-week sabbatical. It's just a publishing thing on our end. So you'll see 2 episodes drop. Thankfully, since our last episode, things haven't really changed. But if you listen to these back to back, I think it would make a lot of sense because we're going to retouch on a lot of those topics. But things are going good. Strong rally to start the year. And we'll talk about that. And we'll talk about what investors should do and how they should think about it.
So let's start right there. So, we had a question here in the deck. Is this a bear market rally? Does it even matter? What's your thought?
Ultimately, whether it's a real tried and true rally, if you're sitting on cash, that's probably the time to worry. We'll get into the fear of missing out and how that ends up being pretty bad for investors as well, right? See 2020, see 2021. And I think any kind of rally, there's going to be people putting labels on it that say it's going to be for real this time, this is fake, watch out, you're going to lose money again. That's what market volatility does. The markets move down and they move up, though. That's volatility, right? So when something moves exclusively down, you simply run out of sellers. If something moves, nowhere but up, you're going to run out of buyers. And those two sides really correct themselves or revert to their means, whatever that mean is or the average is. I think there's always this flow, this balance of the market correcting itself, right? If it's oversold, it's going to rebound. So if we look back in December of last year, maybe that was an oversold situation. And this is, coming back to reality. And we oversold growth companies, for example, right? Now, should they be worth what they're worth, right? Or am I buying something cheaper? And that's what the market's always trying to discover by these fluctuations.
So, and for context, we don't have, again, it's December. It's January 31st, so we don't have January numbers, but it looks like the market will finish up about 6% in January. Does that seem
the U.S.
right?
market, yeah.
The U.S. market, I should say, yeah.
Yeah, we'll get into the international market that a lot of people might be ignoring right now.
Yeah, so the U.S. market's bounced and the international market has bounced more.
Yes.
That's interesting.
Not just recently, too. We're talking about the last year. Surprisingly to me, and probably to our listeners, is international and emerging markets have actually beaten the U.S. markets by a pretty wide margin. So we're going back 12 months. So it's not like this, short week-long rally. It's been going on for a while, but everyone is so home biased, meaning a lot of their portfolios are U.S.-based companies that they probably didn't even notice.
I posted this on LinkedIn the other day, but for the first time in many, many, many years, a diversified portfolio is doing better than the S&P 500. And I know that all of us refer to the S&P as kind of the standard. And those of you that have heard me say this before, I always say the Standard & Poor's is a poor standard. Don't benchmark your whole life to it. But it's because you just don't want to stare at that one index of 500 companies in the U.S. and say this should be what we should do. Historically speaking, smaller companies should do better than giant companies. It just hasn't really happened in the last number of years. So, but we're starting to see that now. When you look at like a 1-year trailing 12-month performance, you're seeing that diversification has, in fact, reduced risk and actually performed better. And that's why we do it, of course, but that's a good sign.
Yeah. So going back to the bear market rally, whether what kind of label it is, I would throw it back to you, Chris, what would you say to a client who is worried about this being like a false rally or a false start?
Yeah. I mean, you never know. You never know. If we were to get our tea leaves out, which clients will ask us from time to time, like, what do you think?
All the time. Yeah.
What do you think the market's going to do? And, I probably said this in a prior episode. I would guess that the second half of this year is likely a little bit more clear than the first half of this year, just because throughout the first half of this year, hopefully we can get some clarity on interest rates. Hopefully we can get some clarity on jobs. Hopefully we can finally get through this recession or not, if we're actually going to get there or not. And that then, as the market becomes more certain, prices then should start to float upward because of that confidence. Markets hate uncertainty, and oftentimes the uncertainty is what causes sell-offs. And then if the certainty shows up in the form of a less bad earnings report, then stocks actually go up in that sense. So that would be our tea leaf reading of the whole market. But the thing is, if you followed that statement to a T and you said, okay, great, I'm just going to start investing in the second half of the year, you might have lost the greatest rally. October to November, so that 2-month period last year was I believe it was the 13th best rally in history. And if you're not investing or waiting around, you miss that type of thing. So what I would tell to a client is you just have to stay level-headed, and you have to stay diversified, because we know that long-term, that's what will ultimately yield strong returns. And when we don't think about it, that's when the market does in fact jump, and we need those returns in order to create that good long-term performance that we're all looking for.
Yeah, we call it climbing the wall of worry. There's always some kind of doubt for every rally. And we go back to 2009, right?
Mm-hmm.
And if you look back at the long-term performance since then, any rally had plenty of detractors and doubters. Famously, Jeremy Grantham, who is a respected economist / investor, he's been calling for a recession or a stock market crash since 2011. Imagine if you listened to his advice, you would have been out of the market, 13 years at this point? That's just not good advice to act on. For context, though, anyone calling for these things are either trying to make a name for themselves, but they're most likely still invested. They're not selling out.
Mm-hmm.
And they're hashing out this advice. A lot of it should come with a disclaimer, but I'd be super leery about anyone who says to the moon for sure, but just as doubly worried about people who, like Robert Kiyosaki, who's always calling for a recession and gold's going to win the day.
Mm-hmm.
And if you've invested in gold in the last 5, 6, 7 years, it's actually been lagging the S&P by, 10-fold, 20-fold.
Mm-hmm.
I'm throwing out generic numbers, but investing in something that, is based on betting against the U.S. economy has always been a losing bet. Mm-hmm. Even post-recession, it's been a losing bet.
Mm-hmm. Let's talk a little bit about how sort of the psychology behind this, right? Markets start going up, and now I want to buy because things seem to be getting better. Yeah. And and then you start to have this FOMO, right? I missed it. I got to get in now. Let's break that down a little bit for all the market watchers out there.
Yeah. FOMO is a real thing, and it got people in the markets, right? We saw a lot of FOMO coming into the markets where I got my nephew or my niece saying they quadrupled their money on GameStop and it's going to the moon and it's a winning bet or crypto or SPACs, or you name it. I think it comes in cycles where the fever pitch of greed definitely explodes. Mm-hmm. I want to say it's like every 7 years or so that happens where, the previous generation or the current generation of investors seemingly forgets about the past, even just for a little bit. There's like this push for speculative growth, right? And yes, there's a place for it, but it has to be scaled down properly. Who cares what your waitress at the restaurant made on GameStop or AMC? Who cares, right? No, everyone loves talking about their wins. They rarely brag about their losses.
Mm-hmm.
And this is industry that has a way of humbling people, right? And even the best investors have big dips or periods where they just are so out of favor, or their investments are so out of favor that, they end up looking like losers. They lose clients over this. They lose performance over this. And I think the fear of missing out, it has to go back to being level-headed, like you said earlier, Chris. It's just, you can't let emotions come into it where you think the stock market is a lottery ticket waiting to explode for you.
Look at Warren Buffett. I think the greatest example of what you just said is look at Warren Buffett over these last number of years. There's been so many people that have come out and thrown darts at him and, oh, he's old and he doesn't understand markets anymore. And, his strategy's out of date and blah, 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 blah. And now you look at last year, a year where his investment strategy did incredibly well relative to everybody who was throwing darts at him. And, I think the hardest part of investing is not changing your strategy in the face of what's top of media. And that's something that Warren has done so well. Yeah. And, how you would comment on this well, Morgan Housel has a fantastic book called The Psychology of Money.
Yeah. Yeah.
And he comments on how Warren Buffett is he's a great investor. He's not the best investor of all time in terms of his return. He's got a good return. But the secret to his wealth is that he started very early and he's done it a long time.
Well, he stayed invested for,
And he stayed invested. Yeah, exactly. And so I think that's the hard part, right? When the hottest fund or the hottest stock or whatever, and we all want to go buy that, knowing when to sell that thing, if you happen to own that thing and you have a big gain on it, but B, maybe just not even buying it to begin with or trying to stay out of it. It's hard. Yeah. It's hard.
It is. Yeah. My whole last year, I actually did not sell anything. It was all buying, but I'm in an accumulation phase. But buying at any point last year did not feel good. In this market, you might feel better, but why do you need market movements up to feel good about your purchases? It should be the opposite way around, because all the big deals were occurring in September, December, right, of last year, where the market did touch its lows, and buying low is probably the simplest thing to say, but the hardest thing to execute in practice.
Well, in sum, if you don't want to have FOMO, stay diversified, because then you won't have to worry about missing the next hottest thing or losing to the next hottest thing, because you'll just own a little bit of all of it, and it goes the right direction over long periods of time.
Well, the opposite of FOMO is the buyer's remorse, right? So people are hesitant to buy because they're afraid of impending crash or
clip in the peak. Yeah.
So that's equally as dangerous, because you're sitting on cash. Granted, cash is earning really healthy amounts, but that's not going to be forever. We all know that the Fed will eventually lower rates, because an overnight rate of 4.5%, meaning that's what the banks borrow at. If they have to borrow at 4.5% and they can only loan out mortgages that are 5%, they're not making money. And if banks aren't circulating money, then the economy does ground to a halt. And I think that's really the mechanics of, in the industry, we call the inverted yield curve, because banks borrow short and they lend long. But if they lend long and there's no yield to get from their costs and their expenses, they're not going to lend out money. That doesn't make sense for a bank to operate that way. So if enough banks do that, that's going to slow the economy, because money isn't circulating.
Okay, so what's causing the rally?
More buyers than sellers. I know I keep saying that.
Okay,
but
so
that's really
this is an internal thing. I have to pivot here. So every time, let's say there's a big market sell-off, and I always ping Hao and a couple other people on the team. Hao, what happened today? And Hao will just go, well, there's more sellers than buyers. It's like, give me more than that. There's got to be more than that. What was announced? So I guess it is that simple.
What was announced? Believe it or not a lot has been announced, other than, we're having earnings that are pretty middling to average. we're in the midst of earnings season. So as Chris mentioned, we're at the last day of January. It's 10 a.m. Pacific, and we're awaiting Amazon. We just got Tesla. We got Microsoft. We got these big earnings reports coming out, and they were pretty blah, right? And there wasn't huge disappointment, or there weren't huge surprises to the upside. So this rally, which that's what we're calling it, could be based on speculation. So the naysayers could be right, but how right can they be? And at one point, will they be right? And well, let's say they're right, but it doesn't happen until next year. That's a year's worth of compounding that you're missing out, right? So I'm answering with a non-answer because there's no real fact here that's showing that we should be rallying, other than there might be a ton of cash on the sideline that had been building up all last year. That's finally saying we got to get back in. It could be short covering, meaning going back to the GameStop days when there are so many short sellers and there were enough buying activity to spark this short covering, meaning if you're a short seller, you eventually need to close your position out by buying more shares of the asset that you're shorting, and that creates buying pressure. So you look at names like Tesla
and Carvana.
Yeah, Carvana was huge, right?
35% a day or something like that because of all the short covering.
Yeah, so these meme investors are buying a lot of options, and that's basically leveraging the amount of buying coverage that you need, because if you're the clearinghouse, you need to cover. The clearinghouse is full of market makers that cover the options. So an option is just the right gains or losses on 100 shares of an underlying stock, right? So using, was it Bed Bath & Beyond or Carvana have experienced this, where they have very poor businesses, especially Carvana. They're probably going to be out of business pretty soon. They haven't officially declared bankruptcy. So that attracts a lot of people who are looking to cash in for that stock to go down to zero, right? So if I'm shorting a stock, let's say I short it at $10, I want it to go down to zero so I could profit $10. So what these meme guys are really caught on was, we can make Hal's life as a short seller really painful by applying a lot of buying pressure. You can apply a lot of buying pressure more so using options, because instead of one share, you're buying 100 shares. And that really increases the amount of buying on the back end, because
that's because one contract is equivalent of 100 shares.
Correct. And that contract does need to be backed by 100 shares eventually. So if you buy enough of those, someone at the market maker side does have to come up with those shares. And if the shorts are covering, those market makers are covering, that's a lot of buying pressure. I think we saw it with Tesla the last few days after Tesla reported earnings. They lowered the prices, and they shouldn't. That's something hasn't traditionally been celebrated in Wall Street, where you lose market share and you have to lower prices to regain some of that back. Your margins go way down, and investors don't like that, but we saw a Tesla rally, pretty strong rally in the last few days. I think that's because of a lot of the retail strength.
Tesla's been an interesting one too, because last year was obviously not a great year for Tesla's stock price, yet more money went into the stock than many other stocks. I don't know the exact quotes, but I remember reading multiple posts on this saying, despite poor returns on that stock, retail investors are just buying and buying and buying and buying and buying. So you talk about more buyers than sellers. I suppose in that case, it just wasn't enough. Yeah. And there's some people that would say, well, hey, Elon sold billions and billions of dollars, but not enough to move the needle. I mean, it's just not, it's like Bezos selling a couple of $1 billion a year. It's just not enough to move the needle in Amazon stocks. These are huge companies we're talking about here. Yeah.
Yeah. And I think it's too big for any one seller, even as big as Elon. But he created a lot of drama, and I think that scared maybe some sellers.
It's got to be a factor, right? It's got to be.
Yeah. But now that, from what I hear, I haven't heard a lot of Twitter news lately, so that could be enough. But if you ever met a Tesla owner, they drink the Kool-Aid. No offense to Tesla owners, but Tesla stock owners too are a little wacko for the company.
Yeah, I mean it's like iPhone owners, right? I mean it's a product and it's a status symbol, and Apple's created this brand that is, I believe, the most profitable product ever, and it's the iPhone. And how do you do that, right? I mean they've been, you talk about inflation. I think the first iPhone was like $200, and they've been able to increase that sevenfold to today's model of iPhone. And of course they've packed more features in, but the cost of other phones have more or less gone down. So, how do they do that? How do they create a brand and, their Apple stores and all these other things? And so, a lot of people have said Tesla is sort of the Apple of cars, and it's a very unique brand. Creates a following.
Even the stock owners, tell a Tesla stock owner that we don't think it's the best stock to own at the moment. You're in for a whirlwind of arguments that
they'll defend
don't
it.
Really, aren't really founded.
So here's my theory on what's causing the rally, because I'm not as simple as there's more buyers than sellers. I think that the market is starting to digest current economic data, and they're starting to think that we are closer to the end of the tunnel than the middle or the beginning. Markets don't trend down forever, right? And that as earnings have come out, you said, hey, they've been kind of lackluster, but I think lackluster is actually good. Because, so we've seen in history, sometimes a stock will get just beaten up. Netflix has been one of them, right? And then they come out with an earnings report that's kind of bad, but it was less bad than what was predicted. And the stock actually went up in the face of a bad earnings report. And so my theory is that I think that earnings has been less bad. And in part, that's contributed to, hey, we're probably getting through this. I don't know what this is, but we're getting through this. And so, stocks have floated up a little bit because of that.
Yeah, it's like being kicked in the teeth, and you feel for your remaining teeth. You see you have two instead of none. Like you kind of, so this is a good way to describe this current rally where inflation's coming down. I think that's one of the biggest fundamental bright spots, where it's continually going down month over month, year over year, however you want to slice and dice it. And inflation's going down. Yeah, it is. And at the end of the tunnel, Chris is mentioning is probably the rate hiking cycle that the market's looking ahead. We know we're in for maybe 2 more hikes, and that's all that's currently priced in. Mm-hmm. But the market will not wait for that second hike to start. It's not like this race we're waiting for a starter to shoot the gun, right? Mm-hmm. Because the market does not wait. Everyone's trying to get ahead of everyone else, and we get this weird rallies at points where nothing feels good. But I think what the point is, everyone who's invested is saying, well, it can't get worse. So we're just going to buy now and ride it out. Mm-hmm. Mm-hmm. That could be a very true thing.
That could be it. Yeah. I mean, hey, if markets are flat for the rest of the entire year, you got a pretty good return.
Really great year.
Really great year. And I know that doesn't sound very exciting, but that would actually be perfectly fine. Perfectly fine. So, and that's why it's important to own equities and own stocks and own diversification, because to your earlier comments, you can earn, I was seeing this the other day, you can earn 4.7% in a 1-year CD right now. That's killer. But you can earn 4.7% in a week. Yeah. Or a month. Yeah. In the markets. And that's not suggesting that you should be in and then be out after that period, because of course you need some years that go to 20% in order to gain a good long-term return, because there will be some years that lose about 15, like last year. But it's just interesting to contrast those two things. The risk-free rate, effectively 4.7% on a 1-year CD, feels good, but stocks long-term should still do better than that, and interest rates should likely
for sure
come back down a little bit.
Yeah.
Okay, and other interesting news, the housing market is showing signs of life. After being kind of locked, places would sit for a while. And I guess I say that is really just a reflection of the last couple of years where you'd list and sell in a weekend. And, that is, let's all be reminded that that is not normal. It is not normal to have such liquidity on your house. Not healthy, not normal, not good. But now we're going back to a little bit swinging towards normal, and likely due to interest rates. Interest rates have spiked, and buyers have sort of sat back on the sidelines. But interestingly enough, buyers have started to come back. And if I'm looking here at this, I have this chart up of interest rates, and interest rates have, they peaked around 7%. And this was this is for mortgages, by the way. So they peaked at around 7% back in November, and they started to tail down since then. And they're right now sitting around 5.5 to 6-ish. And so that seems to have brought some buyers back. I think more than anything, it's just the stability. For context, if we look at a year ago it was 3.5% on a 30-year fixed mortgage. Wow.
Yeah.
And then by May, it was 5.5. By June, it was almost 6. And then finally came down. And then, by October, November, it was 7. And so I think just having some stability over the last couple of months around that 5 to 6-ish range, I think that's actually said, all right, maybe this isn't as bad as it was. And I still continue to think when, if and when rates tick below 5 and it has a 4 in front of it, I think the market starts to go nuts again. Could be wrong, but I feel like there's good likelihood of that happening.
Yeah. I think that's something the Fed will watch out for is
that's a good point.
A return to nuttiness in the housing market, because housing is such a big part of our economy, right?
Mm-hmm.
If I build a new home, I'm going to have this domino effect where I'm buying appliances, I'm adding utilities, I'm adding so many things that are adding to our economy, right? And I think that does need to slow down. It has slowed down, but I think there's a really high floor to that because there's not enough homes, right? Post housing recession, we had a really slow build out in single family homes and apartments. And after 10 years, you just don't catch up. Right. And right now we're feeling it. Right. I've talked about windows being 6 months delayed, and some homes are being sold without windows. They're just boarded up until the windows come in. That's a pretty common practice for a lot of builders right now, because supply has always been kind of steady, because building has always been slow and steady, because no one wants to own plots of land heading into a recession. And I think what home builders are doing now is pretty creative, pretty inventive. I don't know if they'll run into a 2008 level of pullback. I just don't see that kind of irresponsibility in mortgage lending right now. So recession or not, I think housing does have a high floor, simply because, one, supply is so low, and there's more buyers than sellers at this point, right? Like, there's a lot more people who are needing a home, regardless of interest rates. It's a matter of affordability. When you say 4.5%, I think that's a good steady level that we've experienced, in the 2010s, that the housing market didn't go hog wild. And I think anything below 3 is just asking for, reinflation. And
below 3 on mortgage rates?
Yeah, mortgage rates. Which
God, it's going to go nuts.
I doubt that.
I don't know if we'll ever see below 3 in our lifetime.
No.
I mean, I'd be shocked.
Yeah. So, refinancing, activity has slowed down, and that actually slowed down people pulling equity out of their homes to buy jet skis, buy cars.
Yeah.
There's a real slowdown in spending, and I think housing is a big component of that.
In D.R. Horton, so D.R. Horton is a major home builder. One of them, there's many of them that are national. They came out with earnings here recently, and they have signaled, I'm just reading a quote here. So they've signaled that they plan to increase their housing starts this spring in anticipation of more buyer demand. And how you and I were talking about this earlier, about what home builders were doing really in the last 6 to 9 months, maybe 12 months, to try to spur demand on the projects that came online.
Yeah.
Can you speak to that a little bit?
Yeah, I'm not going to say the company, but I ran into someone who I met at a New Year's party who worked for a home builder in California, and they were buying chunks of loans to loan back out to potential home buyers. And what they're doing is using those, basically the bulk discounts. So if I'm a home builder, I buy $10 million worth of loans, I can get a bulk discount. I didn't know you could do this, like buying amounts of money, like you're at a Costco, right? Buying a jug of mayonnaise. The more you buy, the less cost it becomes.
Yeah.
So you could pass along some of those savings to the customers. On top of that, they've gotten creative. Instead of lowering the home prices, they've been buying down points on behalf of the customer.
I have read about that.
So if you bought a home in a new development and you're locked in, the last thing as a builder I can do or should do is lower price for the next buyer, because you, being the first buyer, are suddenly just really pissed off at me and are demanding some kind of rebate or refund, right? And I think that's a really creative way to artificially bring down mortgage rates, because they don't have to keep doing it if demand comes back. So if mortgage rates were 6%, they could buy down the points and get you a 4.5%, 5% mortgage without lowering the price. And I think that's been, in this market, very successful for home builders.
Yeah, that's interesting. It's the biggest hurdle to getting to a home right now is the payment. And so if the builder comes in and says, all right, we'll buy your points, and meaning we'll buy your loan rate down out of the 6% range or 7% range or whatever it was at the time, and lock it in at 5%, that dramatically makes the payment more affordable. And then they can sell the house. And the cost of doing that is so much less than the cost of lowering the price of the house. And you want to support your comps with all the surrounding areas. Because if you sold one house for $500,000 and the next house you sell for $460,000, that's a problem. But if you can sell both of them for $500,000, but just behind the scenes kick in some money to make the next one more affordable, you support your comp and you support that neighborhood, which keeps everybody happy too.
Yeah.
So that's not necessarily, it's just a little bit of behind the scenes. Builders do this all the time, where they want to support their price, and they'll give people $100,000 credit, and all that stuff, because they want to keep their comps up. It does provide a upward momentum in the market, which transparently I don't think is necessarily fair. Yeah. But it happens. So I think it's just worth knowing about.
Yeah, well, if you're a homeowner, I actually did not care whether the home prices moved up or down, because we no intention of moving.
Yeah,
but
long term.
Yeah, and at the same time, I totally understand anyone who's bought a house and then all of a sudden they're trying to sell the house, that same model or floor plan, for 20% cheaper. That's definitely not fair. But we got to get out of the mindset that looking at houses as stocks, right? Looking at Zillow to always see the price move up and down. That's not healthy.
I was reading here as well that some markets have actually seen the return of bidding wars. And this article here, this is a Puget Sound Business Journal article that I'm looking at here that actually came out this morning. And it says that Seattle, Tampa, Florida are two of the markets that have come back with bidding wars, believe it or not. Haven't actually heard about that in the Seattle area, but so this is the first I've heard of this. And also in the Twin Cities over in Minnesota, they've seen bidding wars as well. Almost every day their agents are reporting this. So pretty interesting. I think this year will be a really interesting year in housing, particularly if we do in fact see rates come down. You also had a news report hit from Goldman Sachs that they said, well, these 4 markets are going to totally tank this year and they're way overpriced. One of them was Seattle, one of them was Phoenix, one of them was Austin, and the last one I believe was San Francisco. And so we'll see, right? I mean, these are major calls, as our listeners know. Hal and I always decipher the headlines and say, it probably won't happen. We don't know. No one knows. But generally speaking, when you make a major call like that, what's the quote? Things are never as good or bad as they seem. Let's go with that.
Yeah.
Let's
And
go
I
with that.
think, yeah, we're going to live and die by housing. If it rebounds very strongly, that's going to spur a lot of spending. And I mentioned before, like home equities, appliances, things that go into a brand new home, right? That's all spending that we probably don't want at the very moment.
Mm-hmm.
As long as unless we could get inflation in check. Sorry, I was coughing there.
And speaking of inflation, you had some notes on this here too. So inflation continues a downward trend, which is good. Seems to be kind of spiking in pockets. I'm happy to report that cauliflower was on sale the last time I was at the store. So it still had its stated price. I think it was like $4.99, which is still crazy to me. But then it was on sale twice. And I think I bought a head of cauliflower for like $3.50 or $3.60. So I felt really good about that. First time I went to the store, I sent Hao a text because they were sold out. I was like, man, I really want to buy some, and they were sold out. But then the second time they were restocked, and I grabbed one. So that's good. That's good news.
Yeah. The last episode that we'll probably publish right ahead of this episode was we talked about how eggs have spiked, and we kind of poked fun at it because no matter how expensive eggs get, they're still relatively low dollar amount to people's pocketbooks. Mm-hmm. But people are buying eggs more often than cars or washers and jars, right? So the sting is definitely there because unironically, I guess, my wife went and bought 60 eggs for my daughter's like baking birthday. That cost 60 eggs, or a pallet of eggs costs $60. I don't know how many eggs are in a pallet, but
It's $1 an egg? No way. Yeah,
no, it wasn't. It's got to be more than 60 eggs. But
I don't know what eggs you're buying, man, but I'm not buying dollar eggs.
yeah, whatever the pallet was. So a few, I'm pretty sure it was a few dozen. It was $60, and it that stung. So like a bit of a slap in the face for what we said on the last episode.
But it's kind of like
yeah.
It's kind of like what you said last time. You said eggs, the inflation in eggs people don't see because it might be 50 cents or $1, but inflation in gas prices you see because you drop, somewhere between $50 and maybe $120 on a tank of gas, depending on what you drive. So you feel it so much more when it goes up 10 or 20%, but you don't feel eggs. So you just experienced the gas equivalent of egg inflation because you bought 6 times as many eggs as you normally buy, and it totally hit your pocketbook.
Yeah. So I don't think anyone should pay double digits for eggs unless, again, I mentioned whether you're if you're a bodybuilder or a baker. So, one of those two. I'm neither. My wife's a baker. So, we felt half of it.
You said gas is coming back up. I actually haven't noticed this. And so I guess maybe I haven't filled up recently, but gas is coming back up. This is news to me.
Yeah. CNN took advantage of, slow news week, and gas prices are surging because a bit of cold spells across the refinery sites have slowed down production. But on top of that, we just have a pattern of big gas companies. Exxon, right, posted $56 billion in profit. Chevron, $72 billion buyback. They're raking in the cash, but they're really not doing anything to modernize their production. BP came out and said the market's going to completely shift in 2050 from gas, and that's going to be like the dead stop date, where it's either whatever the new form of fuel is, hydrogen, electricity, alternative fuels, that in 30 years, gas companies won't exist in their current form. So why would you invest in modernizing something that everyone is so opposed to? Or at the same time, you could modernize and reduce costs, reduce emissions with all these big windfalls instead of doing buybacks. I think that, So I don't think gas companies are really doing themselves any favors, but at the same time, they've been, seeing a gradual decline for the last 30, 40 years, right? They are the bad guy here. Yeah.
Is that just because they don't have to? Like, if I'm a market
they don't have to,
that has a
business.
lot of competition, I have to invest in things to try to drive down cost or innovate differently. But big oil is kind of all selling the same product. Yes, I have my preferred gas stations, but it's all kind of the same product.
Yeah,
and
it's
so,
commodity. Yeah.
Right. And so, there isn't really the incentive to say, well, we could make our production a little bit more efficient. Efficient compared to what? They're all about the same.
Yeah. Because you're spending billions of dollars for something that's probably going to die, whether it's in 30 years, 20 years.
We'll see.
Yeah.
We'll see.
Yeah. But yeah, they could be shooting themselves in the foot because let's say we never back off oil. Now they have a system they created in the 1970s that they're trying to, make operationally sound in the 2050s.
We were just talking about oil and total tangent, but you just reminded me. So you remember the news all about gas stoves? Like gas stoves were in the news.
Yeah.
And it was like, gas stoves are going to be outlawed and we can't do, we're not going to use them anymore. And I'm thinking, I have a gas stove. What does this mean? I'm going to have to get rid of it or whatever. And there's all these reports about, it puts emissions in your house and it leads to respiratory issues and then you're going to die. And I'm like, really? This doesn't make any sense. And in traveling around the country, there are parts of the country that almost exclusively have gas stoves. It's just and gas ovens too. Whereas in other parts of the country, it's more like you have an electric oven or electric stove, or maybe gas stove, electric oven, whatever. This is a perfect example of how the media blows things up to the sense that they make no sense. Because the person that's the head of the review that's reviewing this claim or whatever finally came out. I don't know if he tweeted or whatever. He finally came out and said, I'm not going to ban gas stoves. That's the most ridiculous thing in the world. All we're doing here is we're reviewing the safety of gas stoves in homes to try to determine, can we improve the safety of them or the emissions of them to potentially make them more efficient over time. We're not even, no one's even talking about banning. So I was reading that, and that is a perfect example about how the media blows things out of proportion. And we're all used to seeing it based on, of course, stock market predictions. And that's what we talk about here. But that is a great example of something non-market.
Well, I know you love cooking. I love cooking. And there's no way I would use an electric stove. There's no way.
You would have to drag that out of my house. I love it.
Yeah, you'd see me like those tree hugging people who handcuff themselves.
Tree hugging my gas stove.
I'm going to handcuff myself to my stove because that thing is not leaving the house.
Yeah.
I didn't really pay attention to it because I knew it was a bunch of BS. Because understand your source. We use tons of sources. They're all reputable. I'm talking Facebook, Twitter. No,
influencers. Anything that we post is definitely reputable.
Yeah,
so that's fair.
Everything we post is reputable. But no, we use stuff that's
true actually.
that doesn't get published to the public from research shops. So none of them have wrote about this BS news story. A lot of BS news stories are out there that CNBC will publish, CNN will publish, sometimes Bloomberg. But yeah, you got to consider your source and stop panicking over little things. Seriously, it's just, it's like the stock market of emotions, I guess. And every little thing will set people on or off.
Gas stoves. I'm going to be using that example for years now. All right, let's wrap with international. So international's beating the U.S. We talked about this a little bit ago. Should people shift? What should we think? How should we think about international stocks right now?
I think addressing FOMO or addressing buyer's remorse, you should have international already in your portfolio as a well-balanced portfolio to balance against a potential U.S. recession, and only in the U.S. it can happen. Look at the 80s, right? Japan was kicking everyone's ass in the 80s. Mm-hmm. Right? If you were invested only in the U.S., you would have left a lot of gains on the table. Mm-hmm. Even though the 80s were really good for the U.S. investment and stock market. So, get rid of the thought of you're going to beat the world market by going U.S. only because the U.S. has been so dominant for the last 20 years. Well, technically, it's only been dominant for the last 13 years because that lost decade from 2000 to 2009. Guess who beat the U.S.? That's a 10-year stretch of missing out. Now, if you don't have any international, I wouldn't completely swing over. I would be a little bit more modest about it because we want to avoid return chasing as well. Even advisors do this. A lot of old school advisors will look at performance on Morningstar, and just pick the best performers, regardless of risk or, the market environment that caused that outperformance.
It's like picking funds in a 401k. You look at the 26 funds, your investment strategy is to pick the ones that did the best in the 1, 3, and 5 year, put all the money across those 4 funds, and assume that continues.
Yeah.
And it doesn't.
Return chasers might have done well in markets like 2020. Do we want another momentum-based market in like 2020? Well, not so soon, right?
Yeah.
Eventually it'll come. But if you're continually doing that, all you're doing is buying stuff high and selling your losers low. Like, that makes no sense, right? Because if you were going to do this, you would actually sell U.S. when it's relatively lagged to buy international and emerging markets when it's relatively outperformed.
Yeah.
So we're telling you stuff that you probably should have done, but be more modest about it. About, international is not going to always outpace U.S.
Yeah, and really what we're saying is just be and stay diversified, right? I mean, I think it's the, sometimes a client will say, well, how did my portfolio do against the S&P 500? And it's like, well, the portion that is the giant companies in the U.S. did, right about the same as the S&P 500, but then you've got tiny companies in here, and you've got international companies, you have bonds, you have some real estate, you have all this stuff, right? And so, like it wouldn't be a appropriate comparison to compare, say, Domino's Pizza to Netflix. Like you wouldn't compare those two stocks. Those are totally different stocks. And so,
or think about a band where there's no drummer, there's no bassist, and they're all playing lead guitar and all singing. That would be one of the worst bands I've ever heard. Right? You do need other things besides the lead to formulate a band, right?
Yeah. Well, hopefully this is the return of diversification, really adding some consistent value to portfolios. We know that it adds long-term value, but in the short term, look, it's been hard for investors to say, I'm going to stay with this strategy when this thing over here that's in the news every day, the S&P, is just doing the best. And so, hopefully this is the return of that. I will say this, I was recently in competition with another advisor, and this advisor was comparing our portfolio solely to the S&P 500. And, the S&P had done better than a diversified portfolio, which includes bonds. Yeah. And I was chatting with this person with that. And I said, I mean, this is kind of the oldest trick in the book, is to compare a diversified portfolio to a benchmark that's done better than that portfolio and say that, that's this is why or whatever. Yet then the recommended portfolio was very similar to ours. It had international and it had all this diversification in it. It's like, well, why are we benchmarking it against one thing that you're not even recommending? Anyway, I mean, it's my gripe in our industry is that I think that our industry could sell less and educate more. And I think if we were really talking to people more frankly about their money, it would be less of a, anyway, just horribly inappropriate benchmarking strategy against that.
Well, clients, again, that FOMO, it's touching on that FOMO psychology of clients.
But why would you compare to one thing and then recommend another thing? That's not even what. Anyway, I'm still like, come on, you're better than that.
Well, I mentioned old school advisors. Again, not to pick on old advisors. It's just certain advisors that come from cut from a certain cloth. They could be young too, and they take this approach of return chasing, and they're investing using the rearview mirror, where that's really dangerous, right? Imagine creating a portfolio in 2021. It's going to be all Kathy Wood stuff in there, and that would have been really bad for you for the last 2 years. And just because an asset performed poorly doesn't mean it's a poor asset. I say that a lot because we always question, why are you holding this? It lost money. Yeah, that's the point. We purposely put things in there that move in different directions than the S&P, for example, because you don't want an entire portfolio running in the same direction as the S&P. That's just That's so crazy, especially coming off a year in 2022. We seriously looking for concentration risk here? We want to diversify. So if you run into someone giving you financial advice that's solely focused in one region or asset type, they're return chasing. I could tell you that. And they're not looking out for your best interest because they don't know what they're doing. They didn't take the time to properly go through an investment school, right? And I think it is a school of hard knocks because you're actually losing money for people if you do it wrong.
Very true.
Yeah.
All right, let me close with a fun fact. After a bad year, which we would consider last year not a great year, it was a negative year in the market. So the S&P 500 rebounds 83% of the time by an average of 15% after a bad year like last year. And here's why that matters. We're halfway there already. That's true.
1 month in, we're halfway there.
Don't quote that. Oh, God.
We're halfway through the recovery.
Also, on average, we know that the markets pull back 15% any given year. So there will likely be a minus return at some point in this year. On average, every single year that happens, and on average, the market finishes positive. So
you know what that screams to me? Buying opportunity. Anytime there's a 15% pullback.
Absolutely.
Right?
Well, we often send the call for cash to clients at that point. But
you say that happens every year. It's always accompanied with bad news. This year, most likely, I'm going to predict it now, it's going to be with regards to the debt limit drama. It's going to happen in the summer. That would be a good buying opportunity.
Interesting.
I know we don't hash out advice, but again, that's news that's fleeting.
Here's the point that I want to make. So 83% of the time, the market is up following a bad year like last year on average of 15%. Could that be wrong? Well, yeah. There's a chance that the 83% will not be true. Here's why this is important. If you were taking a bet on something, if you were sitting at a casino, your odds are so good. Like, you would never leave the table if the odds were that good. You would continue to invest. So, as I like to say, markets don't settle down, they settle up. And the Standard & Poor's is a poor standard. So we'll leave you with those two things for this episode. Until next time.
All right, everyone. Thank you.